Thank you for rejoining us after a very fine lunch. This is Hillsdale after all, and we can always count on a very great meal and to be well fed. Now, my name is Kris Mauren. I'm the executive director of the Acton Institute from Grand Rapids, Michigan, and I've had the distinct honor and privilege to be involved in this free market forum since its inception. So I want to thank Hillsdale for once again inviting my participation, and of course to the Durrell Foundation. I know Dave is somewhere in the audience for supporting this splendid educational effort. Now, our topic for this panel is in the form of a question. Dodd-Frank, repeal and replace, question mark. Now, in the case that that delicious meal is making you sleepy, or you get an emergency phone call, let me give you the answer to the question. Yes, repeal. And as for replace, why would we do that? Well, because again, this is Hillsdale. I know that 99% that this room is better educated on economics and public policy than 99% of America. You probably all know what Dodd-Frank is. But for a few of you, you may need a refresher, and I can summarize it in this way. It is 2,253 pages of regulations. Now, the bill was written in the aftermath of the financial meltdown of 2007-2008, which itself was brought about in no small part from errant regulations and bad government policies. Naturally, our politicians rushed to the rescue and delivered us the misleadingly named Dodd-Frank Wall Street Reform and Consumer Protection Act, which neither reforms Wall Street nor protects consumers. Have I left anything for you guys to say? Okay. Well, nonetheless, to help us untangle the mess that is Dodd-Frank and why it's important to each of you, we have 3 expert panelists today. And I will introduce them all here at the beginning, invite them to the stage one by one following the other. And following their short remarks, we will invite Q&A from the floor. So let me begin with someone on my far right that I've only just had the pleasure to meet, Peter Wallison. Now, Peter, everybody I've talked to has told me you're a stand-up guy. But don't let the fact that he's from Washington, has worked in government, and is a lawyer throw you. In fact, his background as a former general counsel for the Treasury Department and also counsel to Ronald Reagan, yes, go Kipper, and the present holder of the Arthur F. Burns Chair in Financial Market Studies at AEI makes him highly qualified to diagnose the problems with Dodd-Frank. He's written at least 2 books on the financial crisis, including his latest book, Hidden in Plain Sight: What Caused the World's Worst Financial Crisis and Why It Could Happen Again. Now, following Peter to his left, we'll hear from Paul Atkins. Like Peter, his background in government as a lawyer could be worrisome, but I can attest personally that Paul is a stand-up guy that I've known for more than 20 years. I first met Paul's wife in 1986, I think before you met her, at a small libertarian cabal. She's solid. You married well. Now, I've had the pleasure as well to be with his family on a number of occasions, which includes 3 impressive young men. Now, on the professional side, I can't think of anyone more credible and knowledgeable about regulating the financial sector than Paul Atkins. His early career as an attorney with PricewaterhouseCoopers was as an expert consultant on regulatory compliance, internal controls, and risk management, until his appointment as an SEC commissioner in 2002, where he served honorably for 2 terms. Talk about knowing how the sausage is made. Now, Paul has a solid and well-deserved reputation as a regulation killer. And if we have to have a government, I'll rest easier knowing that people of Paul's ideological commitments, courage, and tenacity are in the mix. That is why I was especially encouraged when Donald Trump was elected and reached out to Paul to help him identify key opportunities for financial deregulation and to identify key individuals who could execute those reforms. Indeed, the Wall Street Journal called Paul Donald Trump's point man on financial regulation. Since leaving the SEC in 2008, Paul founded a very successful consulting company called Potomac Global Partners with offices in Washington and New York. And if starting a real business and employing people isn't redemptive enough, Paul should also get credit as an excellent judge of fine wine and beer. Okay. Now, our final panelist to my left is Nicole Gelinas. Now, Nicole didn't know this until this panel, but we're cousins. It's true. Our common ancestor, Acton Gelinas, we might have said back then, Gelinas, arrived in New France in 1658. At the time, there were very few families in Quebec, and the total population was well under 5,000. So while indeed we are related, probably two-thirds of Canada could say that too. But nonetheless, Acton Gelinas was of sturdy stock. Imagine making a 2-month voyage across the Atlantic in 1658. And if that wasn't enough, landing into the undeveloped wilds surrounded by hostile Iroquois Indians who were oddly not grateful for civilization having been brought to them. Acton was brave and courageous, and those traits have survived to this day in abundance in Nicole, who never shies from the strong articulation of free market principles in policymaking. Nicole is a senior fellow at the Manhattan Institute, a contributing editor of the City Journal, and a columnist at the New York Post. She writes regularly on urban economics and finance. She is a CFA charter holder and an author, most recently of the book, After the Fall, Saving Capitalism from Wall Street and Washington. Please join me in welcoming our distinguished panelists.
Wonderful to be here, and I love the title of this panel, Repeal and Replace, or Replace. Obviously, this law is so devastating to our economy that the question of replacement is not even relevant here. The significant thing is that it was not necessary to begin with. If many of you have attended other of these forums where I have spoken on the housing policies of the U.S. government, which did cause the financial crisis, you know that the lack of regulation of the financial system was not the cause. And so if we could repeal Dodd-Frank, I'm afraid it doesn't look that way in Washington right now, but if we could repeal Dodd-Frank, we would not have to replace it with anything, because in fact, we didn't need Dodd-Frank in any sense. I want to be sure that this thing is working, because I do have some slides, and before I get started, see, I always have trouble with these gadgets. Oh, it came up. Okay, good. Well, let's talk a little bit about the costs to the economy of Dodd-Frank. There are really several elements in the law that have caused or will cause severe problems for the U.S. economy. Now, in the 20 minutes that they've allotted me here, of which I've used almost 2, they are not going to be, I cannot cover them all, but I'll try to cover what I think is the main one, but mention a few at the beginning. One of the major problems with it is the great uncertainty that it causes for the business community. And that's because of several different things that are in the Act. One is the Consumer Financial Protection Bureau, which many of you have heard about, which has the ability to prosecute consumer people who market to consumers for something called abuse of consumers. That's the term in the statute. However, it's not defined. And the Consumer Financial Protection Bureau refuses to define what they mean by abuse. Let me turn off this thing. Where is it? Ah, here it is. Sorry. If I can get this off. No, that didn't work. There we are. Because I think you might, I was sitting in the back this morning, and it's actually hard to see the speaker up here, so I thought I'd get my picture back on the screen. After the Consumer Financial Protection Bureau, there's the Financial Stability Oversight Council, which has the ability to designate certain large firms as systemically important financial institutions. And when they are so designated, they are delivered over to the Federal Reserve for what is called stringent regulation. One of the first to be so designated was GE Capital, which was one of the most successful lenders to smaller businesses, smaller growing businesses in the United States. And GE took one look at what was happening to GE Capital under the regulation of the Federal Reserve and said, forget it, guys, we're getting out. And the way they did that was just to reduce GE Capital from a lender to the market in general to a lender for General Electric's products. Enough with GE Capital, so we've suffered a tremendous loss there. Another regulation you've probably heard of is called the Volcker Rule. The Volcker Rule has pushed the banks out of doing a lot of market making, with the result that there's much less liquidity in the markets that we need. I happen to believe that if we ever have anything close to another crisis-like situation, there won't be enough liquidity so that people can actually cash out on many of the investments that they have made. And as a result, this is likely to be a cause of another financial crisis. But the most significant thing in the Dodd-Frank Act is its effect on small banks. And I will cover that in detail because, in my view, that is the principal cause of the very weak recovery from the 2008 financial crisis and the ensuing recession in 2009, and the very weak recovery we've had since the recession ended in 2009 and right through the end of the Obama presidency. The Dodd-Frank is the only plausible reason for this slow recovery. The U.S. economy is a giant, multifaceted organism that cannot easily be stopped or suppressed. Anything capable of doing so would have to be very large and probably only something that can be done by the government. During the Obama administration, there were only 4 major policies that could qualify for this role. You've heard of them all, I'm sure. The Economic Recovery Act, which sprinkled $800 billion for shovel-ready projects, that was one. The Affordable Care Act, which has been in the news this past year, was the second. And the third that I'd like to just mention is the Fed's quantitative easing program, which reduced interest rates to close to zero. All 3 of those should have been extraordinarily stimulative for the economy. They were not. Why? Because there was a 4th, and that is the Dodd-Frank Act. This imposed strict new financial regulations which overcame all of the stimulative efforts that are the likely source of the economy's, and is the likely source of the economy's suppressed growth. The chart on the screen, and let's see if I can get it back up there. There it is. The chart on the screen shows the weakness of the recovery from the start of the last recession in June of 2009 through 2013. It's prepared by the Federal Reserve Bank of Dallas. Now, the red line at the bottom is this recovery. The black line going through the shaded area is the average of all other recoveries since the middle 1960s. So you see this one is really an outlier. And what we have to do is try to explain why it was. Now, my view, as I expressed already, is that it was the result of the Dodd-Frank Act. As the chart shows, through the first quarter of 2013, there has been some modest economic growth, if far less than in the normal recovery. In fact, an average growth rate of somewhat less than 2% occurred through 2013 and then through the end of the Obama term. Is there then a plausible connection between this slow growth and the Dodd-Frank Act? I will try to show that there is, and it comes through the cost burdens that had been imposed on small banks. In developing and adopting the Dodd-Frank Act, Congress and the administration did not appear to be particularly concerned about placing additional regulatory costs on the financial industry, and particularly banks. For example, for no good reason, all bank holding companies with $50 billion or more in assets were designated by statute as one of those SIFIs, which meant that they were going to be subject to much more stringent regulation. Now, a $50 billion bank holding company is not a systemically important financial institution. If it fails, that will not bring down the rest of the economy. If we talk about $1 trillion or a $2 trillion bank, yes, we might be talking about such an institution, but not a $50 billion institution. And yet, those were all made subject to the stringent regulation by the Fed, which, of course, increases their costs, making it more difficult for them to make loans. But it was for the smallest banks, the $10 billion or smaller banks, which are called community banks, where most of the regulation was most hurtful, because it is only the small banks that have the most difficulty with this regulation. If you're a very large bank, you have many compliance officials, you have many lawyers, they can help you deal with this, but the small banks have the problem of having to stretch the regulatory costs over a smaller base of assets. A study by the Government Accountability Office identified 7 Dodd-Frank titles, which increase the costs or the competitive burdens for community banks. The GAO included as its small banks or community banks those of $10 billion or less. As of 2015, well, let me say this, there are approximately 5,000 community banks in the United States, that is, banks with $10 billion or less in assets. That's a rather large number when compared to the larger banks. There are 98 banks with more than $10 billion, just 98, and 39 with assets of more than $50 billion. So the community banks are the heart of our banking industry in this country, and for good reason, because in this country, most of the growth comes from the startup level. That's where the innovative skills of American entrepreneurs first come into place. Ironically, then, although there's been great concern in Congress about the financial advantages of the too-big-to-fail banks, the heavy regulations of Dodd-Frank have fallen largely on the smallest banks. And indeed, Jamie Dimon, the chair of J.P. Morgan Chase, has referred to regulation as a moat that reduced competition from his smaller competitors because they had so much more regulation to deal with in relation to the size of their assets. Part of the reason that small banks have been losing market share is because of the decline in their numbers and because of acquisitions by larger banks. Both of these can be attributed to Dodd-Frank. Many community banks are selling out to the larger institutions, which can operate more favorably and more profitably in this high regulation business. The chartering of new banks, which at one time averaged about 100 per year, declined to less than 3 per year by 2010. This is almost certainly attributable to the squeeze on profits as a result of increased regulation. If existing community banks can't make a go of it, why would anyone start a new bank? And that's exactly what has happened. Another element causing difficulties for small banks is the narrative underlying the Dodd-Frank Act. In this false story, as I rehearsed a little bit at the beginning, the financial crisis was caused by insufficient regulation of the financial industry, particularly banks. And so, bank regulators and particularly bank examiners took this to heart. And they came out and started insisting on all kinds of new regulations for small banks and successfully impose those regulations on these small institutions. So they have had difficulty making loans to, guess what, small business. The Small Business Credit Survey of 12 Federal Reserve banks recently showed that 61% of small firms experienced credit challenges of various kinds during the last 12 months, with 44% of all small firms reporting credit unavailability or difficulty finding credit for expansion. Growing firms, firms that are succeeding in satisfying their customers, are exactly those that should be able to get credit, yet only a little over half of these firms were able to meet their credit needs. These are certainly small banks, and small firms, because almost all were seeking loans of about $100,000. Which is obviously something that only a small firm would be seeking. The credit restriction for small firms had a disproportionate effect on employment in this country, and that's why over the last 9 years or so, we have had so much difficulty with finding jobs for people throughout the United States. The share of jobs created by different groups is roughly the share of their total employment, but studies have shown an important exception in one context, and that is the contribution of startup firms. They account for much more proportionately than they are among the number of firms. For example, startup firms created about 3.5 million new jobs, according to a study done about what happened in 2005. 3.5 million new jobs in that year. In contrast, every other kind of firm, bigger than a startup, except the oldest firms, exhibited net declines in new jobs during 2005. So it is first the startups that are having the most difficulty getting financing. Now, this is a major cause of the weak jobs recovery since the financial crisis. In 2014, 2 researchers at the Federal Reserve used data in bank call reports to assess whether there is a difference. Oh gosh, this thing is, let's see if that works. All right, okay, back one. Okay, to assess whether there is a difference between large banks and community banks in business lending. Following the financial crisis, they wrote, total outstanding loans to businesses by commercial banks dropped off substantially. Large loans began to rebound in the 3rd quarter of 2010 and eventually returned to their previous growth pattern. You can see that right here. But loans to small firms continued to decline. Here we can see the continuing rise of loans of more than $1 million. Those are to the larger firms, with a continuing decline of loans to small firms. Further, much of the drop in small business loans outstanding was evident at community banks themselves. Here we can see the sharp drop-off in small bank commercial and industrial loans, where large bank loans have remained relatively steady. So again, that fits in with my thesis about what actually happened in after the financial crisis and Dodd-Frank. Dodd-Frank actually caused a substantial decline in loans to small banks, loans from small banks to small business, and that has caused the weak recovery and the weak jobs picture in the United States. It's not generally understood that the United States has a sharply bifurcated credit market. According to the Small Business Administration, in 2010, there were 28 million small businesses in the United States, defined as firms with fewer than 500 employees. Of these, 5.5 million were employers. The rest were small proprietorships, moms and pops, I guess you'd call them, with no formal employees. At the same time, there were 18,500 of the largest businesses in this country, less than 1% of all employers, with 500 employees or more. These two classes of businesses have very different sources of credit. The larger businesses, let's see if we have a slide on that. Yep. The larger businesses have access to the capital markets, and that blue line is how the capital markets have been financing credit for business in the United States. The red line is, and the dotted line is what the banks have been financing. You can see that the capital markets are much more significant in financing business than the banks are. So when you have the banks making fewer loans, then you have the institutions, the companies that are dependent on banks getting less credit and being unable to make the use of the credit in the form of hiring people and so forth. So what we are seeing then is that the small businesses in the United States who don't have access to the capital markets, according to a recent Goldman Sachs study, those small firms, during the period of the last years after the financial crisis, they reduced their employment by about 700 employees over the course of each year, whereas the larger firms that have access to, first, the biggest banks who are doing quite well, and the capital markets increased their employment by about 2,500 employees each month or each relevant period where the study was made. So they were increasing their employment while the smaller companies were declining in their employment during this period, all as a result of the fact that smaller financial institutions were unable to make the kinds of loans that they had always been making to smaller businesses, and the smaller businesses in turn could not then grow themselves and employ. So that, to me, is the reason the Dodd-Frank Act has been such a disaster for this country's economy, and why it should be repealed and never replaced. Thank you.
So great. Thank you very much. Paul Atkins here, and thank you, Kris, for that really nice introduction earlier. It's a pleasure to be here at Hillsdale conference, which I've always admired Hillsdale a lot. And I have to admit, I made a real grave mistake when my eldest son and I were out looking at colleges. And we visited Hillsdale in February of, I think it was 2011. There had been this huge snowstorm, and half the town was out of lights. And so there's no mystery why my son, I guess, chose to go to South Carolina to school at Furman instead of Hillsdale. So anyway, with my youngest son now coming along, we'll make a better decision, maybe go visit Hillsdale in the spring with birds chirping and things like that. It might yield a better impression. But it's a real pleasure to be here with you all and on this topic. And it's, it's a pleasure to follow Peter, who has done such a great job through his career of critiquing regulation at the American Enterprise Institute. Peter started what was the Shadow SEC, he called it, Shadow Financial Services Forum. And so when I was at the SEC as a commissioner, it was always great to know that I was backstopped by Peter and his colleagues with good critiques, good ideas, and whatnot to push back on some of the more problematic ideas that seem to emanate from various parts of Washington. And of course, that was in the good old days before Dodd-Frank was adopted and enacted in 2010. And so what I wanted to do was spend a little bit of time, and I want to expand a little bit on what Peter was talking about as some of the costs of Dodd-Frank, but then also talk about, what to replace it with. I agree with Peter's thesis that it shouldn't be replaced because it wasn't really needed at the beginning. But there are a lot of things that I think Congress can do that would help in the financial services area of barnacles that have grown up since over the last 70 or 80 years with our statutory system and should be addressed. So we'll get into that a little bit. But first, I do want to take exception to what Kris was saying. You came up with a lot, with a few fewer pages of Dodd-Frank than what I've been citing as 2,319 pages is what my count was. That was a committee print at the end. It gets kind of compressed when it gets out into the Federal Register at 800 some, but that's still a lot when you compare it to, say, the Securities Act of 1933 or Sarbanes-Oxley, which came around in 2002. But, basically Dodd-Frank, unfortunately, was a travesty of legislative process. It was rushed through pretty much on a party line vote. There were hardly any hearings about really major provisions of it, and it was subject to really poor draftsmanship. I mean, really egregious things, like, for example, incomplete sentences, completely wrong cross-references, and so things about the statute don't make any sense. And like you probably know, and at least lawyers should know, and most of Congress, of course, is peopled by lawyers at both the staff and the member level. Words make a difference, and even commas make a difference when judges come along to look and try to adjudicate issues later on. And unfortunately, Dodd-Frank is just a complete mess in that regard. Dodd-Frank established 13 new agencies and offices, and so it's no wonder that the costs have soared. And it eliminated one, the Office of Thrift Supervision, which looked after savings and loans. But of course, after 2008, there were really no more savings and loans to look after, so Dodd-Frank put the OTS out of its misery. But never fear, all those employees of OTS were well taken care of. They all found jobs elsewhere in the federal government, and so of course you all paid for that. Anyway, it's just been a problem from the beginning. And Dodd-Frank was really aimed, there were many provisions that were aimed at favored constituencies, so trial lawyers, the labor unions, and other sorts of groups like that of the majority that voted for Dodd-Frank took care of their own. So Peter went through how Dodd-Frank hurt the economy and focused on lending, and especially small business lending. And that chart number 2 that Peter used, I think, tells the whole story of how loans of greater than $1 million, went right back soaring up, and loans up by 40% if you actually look at that chart and figure it out. Loans of under $1 million, so that really means people who are trying to start businesses. So watch Shark Tank or anything like that, and you see how people are not really asking for that much money to get up and going with their new business. They mortgage their houses if they can, or other things like that. So those loans below $1 million having gone down and then leveling off, I think tells the whole story. That delta is pretty marked between the bottom line and the top line. So that tells the story of why new business startups and entrepreneurialism during the Obama years was really problematic. And so a few years ago, I was speaking at a conference down in Florida and was preceded by Austin Goolsbee, who had been the chairman of President Obama's Council of Economic Advisors. And he gave a pretty good speech. This was right before dinner, or right after dinner, I guess it was. And he was jovial with the crowd, and he talked about how at the CEA there back at the White House, they were concerned about how the economy wasn't rebounding because they had expected a V recovery, and then they were looking for a U, and then they were hoping for a W. He went through all the different letters of the alphabet and even the Greek alphabet, and they couldn't really come up with an explanation. And then, and so he bantered with the crowd a bit and took questions, and then so I raised my hand and posed what turned out to be the final question. And so I said, well, thank you very much for your talk, but we've seen all these statutes that have come out, so Dodd-Frank and the Affordable Care Act and FATCA and all these others that had among them, thousands of pages of statutory language, and then as they were being implemented by the various agencies, tens of thousands of more pages of regulation. And I started saying, at that, he cut me off and he said, I know what you're going to say. You're going to ask me, has all that regulation had a downward effect on the recovery? He said, absolutely not. And then he reeled off a couple of citations to studies, and I wasn't quick enough to write it down. And with that, he said, thank you very much, good night. So obviously, I pooped the party. I'm happy to be the party pooper, but obviously, I also, hit a nerve, and I think that even people there in that administration realized that this runaway freight train of regulatory overproduction, was having, downward effect. And so with respect to small business, startups, and the economy coming back up, the regulatory costs, I think, of Dodd-Frank, are really to blame. And then also with respect to the Sarbanes-Oxley Act, which was adopted back, as I said, back in 2002. And if you look at just some of the facts that Peter covered a little bit, but today we have half the number of banks that we had back in 2008. And that's not because the banks went out of business for bad business reasons. Obviously, some of them did. They were overextended with loans or insolvent, but most were not. But there was an affirmative policy by the Federal Deposit Insurance Corporation thinking that the United States is overbanked, and they had a policy to merge banks out of existence. And most of these community banks, like Peter set forth, are the ones that loan to entrepreneurs and startup businesses. And then during that time, they had a policy against approving new banks. Up until now, only about 5 new banks have been approved since 2009, since the Obama folks came into power. And so that tells you a story there about the effect on small businesses. And you look at the capital markets. Today we have half the number of public companies that we did 20 years ago. That means public companies that you can buy or sell on the stock exchange. And the initial public offering market is really in the tank, and that is because, again, of regulatory costs. To become a public company is really very expensive, and so because of all the compliance issues that you have to deal with. And so the IPO market 20 years ago, there were 700 some companies that went public back in 1996. Last year, 100 and some. Now, that's not to say 700 is the right number, but I can tell you that 100 some is not, what it should be. So all of those things have had an effect on the United States marketplace and the vitality of our economy, and that's what the new administration has set out to try to correct. And so from the beginning, the president has been talking about that, and the new chairman of the SEC, who's a corporation finance lawyer from New York, who's a great guy, is setting about to try to deal with that. So hopefully some of these activities, despite the fact that Dodd-Frank is still on the books, will pay some dividends. Let me go through a little bit more of Dodd-Frank in a little bit of detail apart from the negative effects, because the philosophy of it, I think, is also extremely problematic, and one that really speaks to why it needs to be repealed. So from the beginning, Dodd-Frank pursued, as Peter said, this narrative that it was, the evil Wall Street that was the one that drove the cause of the financial crisis. And if we only regulate Wall Street, bring it under control, then things will be a lot better. So the first title of Dodd-Frank, Title I, is called Financial Stability. So the whole idea was, if you get enough smart people in a room and you get enough information and they can peer in their crystal balls, they will be able to prick bubbles before they start. Well, Hayek wrote in his last book, it was called The Fatal Conceit. And so he basically decried this type of propensity of Washington and other governments around the world, basically for that we need people who are smarter than the average bear to figure out how to do things that the market is more equipped to do. And so the Dodd-Frank set up this Financial Stability Oversight Council, which Peter alluded to, the FSOC it's called, and they have a power to designate particular banks or other non-bank financial institutions as being systemically important. So they're called systemically important financial institutions, and it's abbreviated to SIFI. Now, some people pronounce that SIFI. I refuse to do that. And Barney Frank said that, it sounds like a venereal disease, and I think he's probably right about that. But I would argue that SIFI should be pronounced the same as HIFI, which you pronounce as hi-fi, or WIFI, which I'd pronounce as, or SIFI then should be pronounced as sci-fi, exactly. And that's exactly what this whole regime is built upon. Science fiction as far as getting these people to declare these particular institutions as systemically important. Right, well, thank you. So they, like Peter said, they went about they were required by statute to declare the big banks as sci-fis, and then they went about to declare some market utilities like the Depository Trust and Clearing Corporation and other things like that as sci-fis. Then they looked at non-bank financial institutions, GE Capital, and so Jeff Immelt was so infuriated that Federal Reserve examiners wanted to come in and sit in Mommy GE's board meeting that's when he said, we get rid of GE Capital as fast as we can. And then they declared AIG, an insurance company, Prudential, another insurance company, MetLife, they declared a sci-fi, and MetLife was the only one that was brave enough, Steve Kandarian, the CEO, to fight back and sue over that, and actually won in district court in Washington. And that's one thing, write your congressman, write the Secretary of the Treasury, Stephen Mnuchin, because the Obama administration took that decision, that was a very good one by the federal district judge, and appealed it up to the circuit court in DC. And right now that's pending before the Treasury. And so Secretary Mnuchin is going to have to make a decision here coming up. They've kicked it down the road a bit, whether or not to continue that appeal. I say drop the appeal, let it stand, because basically the judge said that the whole construct of this FSOC is problematic, that in their declaration of these various companies to be sci-fis, they just had a very flawed process, and it needs to be redone. So hopefully Secretary Mnuchin will decide not to pursue that appeal. So anyway, so those are some of the issues, but as they were looking at declaring other things like asset managers, what the Fed, which is behind a lot of this designation process of the FSOC, was after is control over your mutual fund, over your 401k plan, and over your IRA. Because of what they want to do by declaring asset management as an activity being systemically important is being able to say to asset managers in time of crisis, thou shalt not sell a particular type of security in order to calm the market, and because they're afraid of people just dumping their securities and fleeing. And we all know if you are in the marketplace and you tell somebody that you may not flee, that just makes people even more panicked, and they want to flee faster than possible than they would have before. And so I think it's just a very short step then from being able to tell somebody that thou shalt not sell something to be able to say, like they do in Argentina, thou shalt buy something in order to support the price, and with a rationale, well, we'll try to keep our banks solvent by supporting their reserves and their capital structures and what they have undergirding their capital. So that's a fear that I have, and people who say, well, that can't happen in the United States, all I have to do is point to the TARP program and how they told every single bank, or most of the big banks back then, that you must take TARP money even if you don't need it. So there are all sorts of things that I fear in the future if this sort of power remains with the government. So Dodd-Frank has a lot of other things that are problematic. Like Peter touched on, the Consumer Financial Protection Bureau. There are a lot of things in the titles that deal with the SEC, for example, that give administrative law judges huge new authority to, which I think is unconstitutional, and there's some challenges up to the Supreme Court with respect to these ALJs and their authority to be able to fine people and companies and even to take their livelihoods away without all the protections that one has in normal federal courts. So there are a lot of things that need to be done with respect to Dodd-Frank and repealing it. But what do we do, if we can't repeal it? And so that's one thing that, we're looking for next year as far as, Senate seats that are up, and hopefully we'll be able to increase the number of Republicans in the Senate. Because right now, and I told this to the president, or gave this analogy to the president early on after the election, that if we are not able to get statutes through, I compare the regulations to sandcastles. So the Obama administration erected all these sandcastles of regulations that now with our tide, like at the beach, we're coming in, our tide is coming in, and we'll be able to wash away these regulations because we'll be taking over the regulatory agencies. And then we'll erect our own sandcastles. And unless we can undergird those sandcastles with rebar and concrete, they will be washed away inevitably in the next, hopefully 20 years or whenever it might be, when the next tide comes in from the other side. And so unless we can get statutes through and then also get that supported with a good litigation strategy, with good opinions coming out of the courts, it's going to be problematic. So the House of Representatives last year passed, or this year I guess it was, passed what's called the Financial Choice Act, which is based upon market principles and trying to have a goal of repealing Dodd-Frank and ending bank bailouts, ending too big to fail, trying to bring in more market-based type of practices into our regulatory structure, more transparency, open up the Fed, audit the Fed, except for monetary policy. But all of that transparency, I think, is a good thing because you cannot have democratic institutions that operate in an opaque, non-transparent way. That's just not the way things should operate in our society. So with that, let me stop. I'm happy to talk on, but I should let Nicole speak to us, maybe in French Canadian, and see if even those of us who understand French can understand that. But no. But anyway, it was a pleasure to talk to you, and happy to take questions afterwards. Thank you.
Good afternoon. Congress is not going to repeal or replace Dodd-Frank, and that is not because Congress is irrational. Rather, it's because Dodd-Frank is doing exactly what it was designed to do 7 years ago when President Obama signed it into law. Now, you may be thinking, wait a minute, that's not true. I know my Dodd-Frank pretty well. I'm sure you've all read quite a bit about it over the past 7 years. And you may believe that Dodd-Frank had two purposes. One was to end too big to fail. As the president said when he signed it, this law will end taxpayer bailouts once and for all. And two, to protect consumers from predatory behavior. Now, clearly, Dodd-Frank has not ended too big to fail. Before 2008, the country had 7 mega banks, and they each had a market share of about 7%. Today, the country has 6 mega banks because one of them bought another one, and each of their market share has increased to 11%, close between 10 and 11%. And moreover, the Dodd-Frank's philosophy is not to allow for failure by cushioning the economy from that failure. In other words, in a healthy economy, a financial institution, even a very large global financial institution with several $1 trillion worth of assets, should be able to fail, and the economy should be able to withstand that. That is not what Dodd-Frank did. And Dodd-Frank, contrary to that free market philosophy, tries to prevent all financial failure, which should be impossible. Now, on consumer protection, did Dodd-Frank succeed in protecting consumers? And I'll give you a 2-word answer to that question: Wells Fargo. Wells Fargo, before the presidential election last year, it was revealed that the bank had systemically created 3 to 4 million fake accounts. This is, in effect, identity theft, and it wasn't just a few rogue employees looking to increase their bonuses. This was systemic failure to protect against a risk that responsible corporate executives should have known would arise with the wrong incentives and the wrong compliance procedures. What has happened to Wells Fargo since then? Well, not very much. Of course, its executives have to go through the ritual congressional testimony. Top people have had to resign. But they've set aside $1 billion in provision for future fines. That's a very small percentage of their profits. And they will most likely continue to be one of the nation's large financial institutions, despite this very real systemic failure. Now, if Congress had wanted to end taxpayer bailouts and protect consumers, there were easy, straightforward ways to go about doing that. The way to prevent taxpayer bailouts is to allow for financial firms to fail. The way to allow financial firms to fail is to protect the economy when those failures happen. And the way to do that is done through higher capital requirements. In other words, if my bank has $10 in assets, it has to have a certain percentage of those assets in non-borrowed money. That means, first, if there is a downturn, hopefully that cushion of non-borrowed money should protect the bank to some extent from loan losses and other bad decisions. But if the bank has made such bad decisions that this non-borrowed money is used up, it then can go bankrupt without taking down the rest of the economy. Why is that? Because you want your capital requirements to be consistent as well. That the government only says, what is the percentage level of capital that these institutions have to hold? It is the financial institution's job to decide what kind of investments are risky and what kind of investments are not risky, as long as they hold this particular level of capital. That way, financial institutions will make all different types of mistakes rather than make the same mistake at the same time as they did in the years leading up to 2008. Now, if in doing these things will automatically protect consumers, because a higher capital cushion results in less debt overall for the economy, which is good for consumers, particularly poorer consumers who simply cannot handle the debt burden that they've taken on, not just in recent years, but over more than 3 decades. Now, this gets to why would we do Dodd-Frank when Dodd-Frank is not simple and straightforward? Dodd-Frank is difficult and complex. And the Congress people and their staffers and their lobbyists are not stupid. If they wanted to achieve these goals, they would know how to do them. But these are not Dodd-Frank's real purpose. Dodd-Frank's purpose is to maintain a private sector economy that is addicted to cheap private sector debt, and that has been addicted to cheap private sector debt for more than 3 decades. So we'll go back in time a little bit. What happened starting 35 years ago? Wage stagnation. I'm sure you've heard a lot about this in the time leading up to Trump's election. Began to make itself apparent among the working class. 35 years ago, if you were the breadwinner in the 40% percentile of households, you made about $41,000 a year. This is your person who's graduated from high school, has a skill, made a reasonably good living. Today, that same household breadwinner makes the same amount of money after inflation, $41,000 a year. So the working class household has not made any real wage gains over 35 years. There are many reasons for this. Lou Dobbs mentioned some of them last night, from the competition from trade deals to the ripping up of the Iron Curtain, which gave the West billions more potential workers as competition over the past 35 years, not only Eastern Europe, but China being a part of that and opening their economy to competition. And family formation is also a reason for this. The reasons can be debated and discussed, but the reality is there. So what happened when wages started to stagnate? You would think that consumer spending would have gone down, prices would have gone down, that this would have had an impact on the real economy. But that was not true. And why is that? Because people substituted debt income for wage income. And this was encouraged by the governments on a bipartisan basis because it allowed the governing class to avoid a lot of the difficult questions that people have been raising just over the past few years. So from 1980 to 2008, you can see how debt became a much greater part of people's day-to-day lives in the numbers. Over these years, mortgage debt quadrupled after inflation again. Credit card and auto debt nearly tripled. The population only went up by 30%. The mechanism of pushing out, the main mechanism for pushing out all of this debt to the average consumer was houses. You may think that mortgage borrowing, the purpose of a mortgage loan is to purchase a house and then to pay that debt down over time so that when you have retired, you have this asset to hand down to your family or to sell and finance your retirement. But starting in the late 80s, early 90s, houses were a mechanism to get other consumer debt down to the borrower. Alan Greenspan and James Kennedy did a study that said starting in 1991 through 2005, people used home equity loans to take out more than $500 billion every year from their houses. They used that to finance their consumer spending. In other words, someone owns a house, they've been trying to pay the mortgage, but suddenly they find themselves with $10,000 in credit card debt. They had to pay for school for a child, not college, but high school or elementary school. They had a medical expense, or their day-to-day spending simply does not keep up with their day-to-day expenses. These are not trips to Europe. This is not blowout spending. This is a compilation of consumer debt because people are not keeping up with cost. And so what does someone do when they run into a debt that makes them uncomfortable? They would go and refinance their house, take that money out, pay down the credit card debt, and start over. Now, after 2008, really after 2007, the markets tried to correct this. If what was left of the free financial market said, there's just too much private sector debt in the US, to a lesser extent in Britain and in the rest of the West. People have borrowed all that they really can. They can't borrow anymore. So let's stop this and figure out how to fix this economy. What did the government do in response? Not only the US government, but Western governments around the world as well. They tried their best to keep the system going. They didn't want a change, whether a gradual change or a sudden change, and gradual change is always better, but if you don't allow for gradual change, you will get a sudden change. They didn't want to change from a consumer debt-based economy to a more productive wage income-based economy. So they, as Peter mentioned, the Federal Reserve and other central banks began quantitative easing, try to push more debt into the private sector economy. But the other issue was what to do about financial regulation. People were clamoring for new financial regulation. The answer was Dodd-Frank. So what do you do if you have to do financial regulation, but you don't really want to do financial regulation? This is a puzzle. Why is this bill so large? Well, first of all, they couldn't touch Fannie Mae and Freddie Mac because these are the mechanisms to get cheap debt through housing to the American public. So we have this Dodd-Frank law. Despite its many, many pages, it doesn't say very much about Fannie Mae and Freddie Mac. The second thing, you really couldn't touch consumer credit. So Dodd-Frank, it maintains a system of weighting which allows financial firms to rate securitized consumer credit as not risky. What does that mean? It means in capital requirements, although capital requirements are higher, something that is rated not risky, it doesn't require a financial institution to put capital behind it. So if I'm a financial firm, I'm securitizing credit card debt, I sell this debt on to the global capital markets, I don't have to put capital behind that. These financial firms can still be a conduit for cheap global consumer credit from the average American to the global capital markets. And so we can't touch the two major issues that cause this problem: housing debt, credit card debt, and auto loan debt. So what can we do? Well, a lot of delay and diversion. Dodd-Frank required 390 rules. By the time the Trump administration was inaugurated, only 75% of them were done. 21% of them were not even proposed. And many of the rules that are completed are very vague. The vocal rule, for example, this alone is 1,080 pages. This is not part of the official page count of the Dodd-Frank law. But you can read these pages and you won't know what banks are supposed to do, what is considered speculative trading that is prohibited by the vocal rule, and what is considered market making or hedging. And no one can really tell you whether at a bank or at a regulator. Now, the other part of Dodd-Frank that does exist versus what they should have done that doesn't exist is the orderly liquidation authority. This is a way to maintain too big to fail so that these large financial firms can continue to be a conduit of cheap consumer credit. What does orderly liquidation authority mean? It means if a JP Morgan Chase or Citigroup has financial trouble and seems to be on the verge of failing, the government doesn't allow it to go through bankruptcy, which features important checks and balances. It is the judicial branch that oversees the liquidation or the recapitalization of the company, so there's some independence. But in orderly liquidation, by contrast, it's largely handled by the executive branch. A failing bank can be seized by the executive branch of the government, and it can be run for 3 years by the executive branch of the federal government. If they need 2 more years, they just have to tell Congress that they want to run it for 5 years. So it's interesting when many people on both sides or no sides of the political aisle say, I worry that Trump, he's doing irresponsible things with the power that he has. Well, if you think that Trump is irresponsible or any president is irresponsible, why would you put him or her ultimately in charge of a bank with trillions of dollars worth of assets for 5 years. But that is what Dodd-Frank allows. And in running a bank for 5 years, the government can favor certain creditors over others, pay off certain derivatives and other transactions while letting others take losses. There's no real consistency here. It is what officials in the executive branch think is necessary to maintain financial stability. Now, the implications of this so far is that from Congress's perspective, it has succeeded, that consumer debt has continued to increase. It went down from 2008 to 2014, but it has gone up again, and much of that decrease was mortgage write-offs. It wasn't the gradual change that our economy needs. Now, today, credit card debt is back up to where it was before 2008, and a lot of people consider that to be a success for the economy. Auto loans, you go out to a parking lot, everyone has an SUV that's worth $40,000 or more. They did not buy that. They took out a loan, 0% financing, and when that SUV is past its useful life, they will still owe money on that car, and they will give it back to the bank, having to either make a payment or roll it over. This is not a sustainable way to run an auto industry and the hundreds of thousands of middle-class jobs that depend on it. And what's going to happen next? Well, Trump, as both Peter and Paul mentioned, the president has created a commission to figure out how to fix Dodd-Frank, and they've put out 2 reports so far with some pretty good, if very incremental ideas that they can do through the executive branch rather than legislation. But just to illustrate the absurdity of the law and the attempts to address the law, who is in charge of figuring out how to fix Dodd-Frank? It's the Financial Stability Oversight Commission, which is itself, as both Peter and Paul mentioned as well, a creation of Dodd-Frank. The FSOC is not going to recommend getting rid of itself. It's very, very unlikely. So what should the president and what should Congress do? Congress should repeal the Volcker Rule. It really doesn't do much of anything at all, and it maintains this philosophy that the government should decide what's risky or not these financial institutions. And they should certainly repeal the Orderly Liquidation Authority, because again, this is prevent failure rather than allow for a free market economy to withstand failure. But I would be surprised if either one of these things were to happen. Thank you.
Thank you much. We have time for questions, and there are microphones around the room, so please raise your hand and someone will come to you.
I think 2 of you mentioned about the quantitative easing. Now, the Federal Reserve, through the quantitative easing, has increased its assets by about $3 trillion. And they're going to reduce that asset over time. How would that impact the economy? Can that be compared to the Dodd-Frank impact on the economy?
Is this mic working? Yes, I guess it is. Now, I am a lawyer, not an economist, but I can make a guess about what would happen with quantitative easing. First of all, much of the quantitative easing was done through the purchase of Fannie Mae and Freddie Mac securities. They were taken off the market, went into the Fed's balance sheet, and when they came off the market, that meant that there was less competition for U.S. government securities because Fannie Mae and Freddie Mac securities were backed informally, but known to be backed by the U.S. government. When that happened, that caused Treasury securities to decline in their interest rates. So what I think will be done with quantitative easing is they will just allow the Fannie and Freddie securities that they bought to run off, which means that people will just pay off their mortgages. And though when people pay off their mortgages, the assets that back those securities decline. The money comes into the Federal Reserve. It will then be paid over to the Treasury Department probably, but that should not have much of an impact on the economy over the long term. If the Fed were actually to try to liquidate those securities, right now it would have a major effect on the economy for exactly the opposite reason of what I just talked about, because that would make it a glut on the market, all of these new government-backed securities coming onto the market, and it would probably cause a lot of inflation. So I think that they will just hang on for a while and not make much of a change in that balance sheet. But all of this is subject to a lot of speculation and concern at the Fed, so it's a guess on my part.
Well, and also, I agree with Peter, but one thing you have to remember about the Fed is that there's very little transparency into what exactly it has. So that's why when people talk about, the need to have a real audit of the Fed, I think in many respects that's correct. If you look at the fine print of, I think Deloitte & Touche is the auditor of the Fed at the current time, but there's a lot of disclaimer as to what their process is. They don't follow GAAP, generally accepted accounting principles. They follow the Fed's own rules as to how they value and account, how they put together their financial statements. So we don't really know what they have, and they've been buying and selling U.S. Treasury securities, and as Peter says, other GSE securities. So, who knows what the real values are. And of course, the Fed is the ultimate inside trader in these markets. They're in there and they make some of the markets, and they, through their buying and selling, they can affect the prices and also their profit or loss on their trades. So, and you can tell probably which way they usually go on whether it's profit or loss. So anyway, so it'll be interesting to see now that new personnel will be coming into the Board of Governors. I'm looking forward to maybe perhaps a different approach.
Yes, I guess this question is for Mr. Wallison. When you were giving your list of things that I guess mainly happened under the Obama administration, the Affordable Care Act and those other things, I was wondering if you factored in the cash for clunkers bailout, so to speak, and also the multiple extensions that were done on the unemployment insurance that lasted for some people up to 2 or 3 years.
I did not include those, but you could. They were much smaller than the other things in terms of their impact on the economy. I thought cash for clunkers was to help the automobile market recover a little bit by taking these clunkers off the market, and then and so people would buy new cars. And those other programs also were modestly helpful to some people, but the point I was really trying to make was simply that here are these gigantic influxes of cash into the market, ACA, Affordable Care Act, cash pouring out to the insurance companies and through them to the healthcare industry, over $800 billion to sprinkle onto shovel-ready projects that weren't apparently shovel-ready. That didn't work. These are major amounts of money, and they had no real effect on the course of the economy. The economy did not recover. And in fact, plenty of studies, I didn't have a chance to mention this, of course, but plenty of studies have shown that when the government is active in dealing with a downturn in the economy, it causes the recovery to be much slower. And it's been so clear for years that has been happening that we really don't seem to learn from the past. There's been a very good book out that showed that this is a James Grant book that shows that the recession, really depression in the year 1920 was huge, but it lasted only a year because the government did nothing. The government had no policy at that point, and the economy bounced back, and we then had the roaring 20s after that.
I was wondering, is there any chance that the Consumer Financial Protection Board will be repealed? Because it seems to be very unconstitutional.
Nicole, I can do it if you...
I don't think it will be repealed, and the avenue for big change would be through the court system. But going back to the point about being concerned about President Trump being ultimately in charge of a large bank for 5 years, the Democrats and Republicans who are also concerned about checking any one branch of government's power, the provision that the sole person in charge of the CFPB, his term outlasts the president's, but he has no commission to keep him in check. Every other government agency, it's either one or the other, that you can have a term as a commissioner that outlasts a presidential term, but that means there's a commission of 5 to 7 people. That's how the SEC works, that's how the FTC works, so that one person does not have this power that is supposed to be insulated from politics. Or you can be solely in charge, but you serve at the pleasure of the president and can be fired by the president. The CFPB is the only one that is not one or the other. It's one person whose term outlasts the president's. But when Mr. Cordray's term is up, Trump is going to be able to nominate his own person. So you would think, and that person's term in turn will outlast the next election. So if you were hoping that Elizabeth Warren becomes president after Trump, well, without big changes to the CFPB, either through legislation or through the court process, she would not be able to nominate her own person. She would be stuck with the Trump person for half of her first term. So these things have worked out well for the people who signed Dodd-Frank into law, but they can be used against them, which is why we should stick to these democratic principles of checks and balances, even if we don't like the short-term outcome in some cases.
Yep. Just to throw a couple more points in. So, anything that's entitled the Consumer Financial Protection Bureau, you have a political issue of whether or not, whether it's possible to repeal it. Even the Financial Choice Act that was passed the House doesn't provide for the repeal of the CFPB, but like Nicole was saying, it institutes a commission, it puts it on the budget of the U.S. so that there's more control over Congress. I think what they should do is, repeal it and then put it back into the various agencies as it was done before. But anyway, there are 2 tests that are coming up in Congress that will be interesting to see what happens. Richard Cordray, who's the director, pushed through a rule basically getting rid of mandatory arbitration clauses in contracts for various consumer financial products. So that's up before the Congress now under the Congressional Review Act. And as you know, Congress for the first time really in a systematic way has gone over and thrown out a number of regulations that were adopted, in the final year of the Obama administration. So now this one that was just adopted by the CFPB a few months ago, is up. We'll see if we have the votes in the Senate to overturn that one. And then just the other day, the CFPB adopted another rule regarding payday loans, basically putting that industry out of business. And so we'll see what happens in Congress with respect to that one. So that's a good test to see what the politics are.
One of the things that, I'm over here, one of the things that is not talked about very much in Dodd-Frank or other types of legislation is the ethical impact of this government legislation. In this particular case, two ethical areas stick out. One, something we call the moral hazard, something that appears to have a short-term benefit, but in the long run has negative consequences. And I wonder if some of you would address that, the negative long-term consequences, not only of bailouts, but of other areas to try to protect people and businesses in the short run. The second ethical issue, which I think is even more important, is indebtedness. Do we want to encourage continued indebtedness? I know we're a consumer economy, but again, you know what the Bible has to say. The borrower is the slave of the lender. And it's not prohibiting borrowing, but it's warning against it. And so I think, you know, as we try to encourage more and more borrowing, more and more indebtedness, we are doing a disservice to people, and in the future, they're going to feel the problem there. So I'd like some of you to comment on that. Thank you very much.
I'll try to deal with that because I have talked a lot about the moral hazard issue when I talk about housing policy. Fannie Mae and Freddie Mac, as I indicated, these two very large mortgage companies, their business was buying mortgages that were made by banks and other lenders, and then they would hold these mortgages and turn them into mortgage-backed securities and sell them to the public with a government, with what was essentially a government guarantee on them. So here's where the moral hazard comes in, because with the government guarantee, no one cared about the quality of the underlying mortgages. And as a result, we had a period of time between about 1992 and 2008 when terrible mortgages were being made in the United States. Fannie and Freddie actually wanted these terrible mortgages because they were required by the government to buy mortgages that were made to people who were below median income, and those people could not come up with the down payments and have the stable incomes that enabled those mortgages to be good quality investments. But nobody cared. Who cared? Because, in fact, anyone who was buying a Fannie and Freddie security, and many, many people did, they said, well, I don't care what is underlying these securities because the government is backing them. And as a result, that's where moral hazard is exactly the problem. And that is that it allows things like transactions like this to occur where we had, well, almost $5 trillion in assets in the form of mortgages in the United States, of which about a little more than half were subprime mortgages that fell apart as soon as housing prices began to decline in 2007. That's moral hazard. That's why we ought to get the government out of not only the housing finance system, but we ought to get it out of a lot of other, backing a lot of other debt in the United States. We've just heard about floods in various places. I think there was some place nearby where there were floods. Can't remember exactly, but the federal flood insurance program is all full of moral hazard. People are able to buy homes on the beaches, right on the beaches, even though there's going to be a flood, because the federal flood insurance program is very weak in terms of what it guarantees. And so it's creating more moral hazard. People taking more risks that they wouldn't otherwise take if they did not have the government's backing, telling them that the risk is going to be managed in the future.
I I would add only that another moral hazard, if you will, is this social hazard that many people are still surprised that President Trump won the election. But a big reason why he won goes back to 2008, that people were so angry at these bailouts and at the perception, which was a correct perception of unfairness, that if I run a small business and I have bad luck, my business will fail, but if I run a large bank, I have bad luck, the government will step in and rescue my bank, and maybe I'll lose my job, but I've still got tens of millions, if not hundreds of millions, to take home with me after I've lost my job. And people could see that this is not a free market financial system. But the establishment Republicans, if you go back to the debates, and this is, by the way, this starts in 2012, and Romney would never repudiate the financial bailouts. He was given many opportunities to do so, but he just would never do it. It just was not in his character to say anything critical about a bank, when it's not being critical of a bank to say they should fail if they make decisions that lead to their failure. Same thing in 2016. These candidates were afraid to be critical of large financial institutions and say very clearly that they would hold them subject to free market values. And I think the public can understand that better than the establishment could. And this created what we have today. A lot of people are unhappy that Trump won for many different reasons, good and bad, but he would not have won if we had had a free market economy back in 2008.
We have time for one more question.
Yeah, I want to continue with this theme about government creating a distorted marketplace in which consumers and businesses are acting and interacting in fashions that not only compromise their current situations, but also put the future at risk. And the bottom line is the children of today are going to be our bankers, our healthcare workers, our investors, and we are setting them up for failure. You talked about the mortgage industry. Look at the student loan industry and the subsidization that's taking place there. That is driven by Sallie Mae. Then you look at the car industries. You speak about SUVs. We're allowing people who are not credit worthy to buy these huge SUVs, and they're driving them for 6 months, and then they're turning them in, and the subprime auto loan market is about ready to fail. So it's government incentive, and people present themselves as trying to do well, and yet they are causing not only our own personal wealth to be put at risk, but they're compromising the futures of our children. How do you respond to that?
Yes or no?
Doesn't sound like a good idea. You're completely right. And this is politics. And the only way we're going to stop this is if all of you in here, or anyone who agrees with what the lady just said, gets to his or her congressperson and senator and says, this has really got to stop. People have to take responsibility for the things in their lives. And if the government is going to take over the things in their lives and take responsibility for it, well, then eventually we all become responsible for the irresponsibility of those people because they've been encouraged to be irresponsible. We've made them irresponsible. So that's the lesson I think that we all have to learn from when the politicians try to help people.
Thank you, Peter. And the lesson we know from socialism is if we're all responsible, then no one's responsible. So our time is up. So I would like to ask you to once again thank our distinguished panelists.